intelligent investor. In this video, we are going to share with you a very knowledgeable book summary. The book name is Intelligent Investor. Benjamin Graham, who is frequently referred to as the father of value investing, is the author of the classic investment book, The Intelligent Investor. Since its 1949 debut, the book has grown to be a mainstay in the financial industry. In this video, we are going to give a thorough review of the main ideas and the concepts discussed in this book. The first chapter of the book is about investment with speculation. In the book's first chapter, the distinction between investing and speculating is emphasized. According to Graham, investing entails examining a company's financial statements and business model to determine its fundamentals and then making a purchase based on that analysis. Contrarily, speculation entails making a purchase based on current market conditions and predicted developments. The chapter 2 of this book is about the investor and the inflation. Graham explores how inflation affects investments in this chapter. He contends that investors should take inflation into consideration when making investment decisions, since it might gradually reduce the purchasing power of money. The term margin of safety, which describes the discrepancy between a company's intrinsic value and its market price, is also introduced by Graham. The chapter 3 of this book is about a century of stock market history. An outline of the stock market's past centuries' history is given in the third chapter. Although there have been ups and downs in the stock market, according to Graham, overall long-term returns have been positive. He places emphasis on the value of long-term investment planning and avoiding volatile short-term market conditions. The chapter 4 of this book is about journal portfolio policy, the defensive investor. Graham presents the idea of the defensive investor in this chapter, who aims to reduce risk and provide steady, reliable profits. He suggests a portfolio split equally between equities and bonds, with an emphasis on high quality, low risk investment. Graham also stresses the value of diversity and preventing a stock or industry's over concentration. The next topic in this book is about the defensive investor and the common stocks. The fifth chapter goes into more details about the defensive investor's strategy for buying common stocks. Graham advises concentrating on big established businesses with a track record of consistent earnings and dividends. He also emphasizes how crucial it is to review a company's financial records and take its valuation into account before making a purchase. Chapter 6 of this book is about the portfolio policy for the enterprising investor. Negative approach. The Graham covers portfolio strategy for the savvy investor in this chapter, who is willing to take on more risk in search of greater rewards. He suggests a negative strategy that actively seeks out inexpensive or underpriced stocks while avoiding those that are overpriced or overvalued. Next chapter of this book is about the portfolio policy for the enterprising investor, the positive side. The concept of the portfolio management for the astute investor is continued in the 7th chapter, which emphasizes a positive outlook. Graham suggests a strategy that includes in-depth company analysis, seeking for chances to buy in inexpensive or ignored stocks, and actively managing the portfolio to benefit from market changes. The next chapter of this book is about the investor and the market fluctuations. The significance of a disciplined long-term investment plan in the face of market changes is emphasized by Graham in this chapter. He contends that traders and investors should not try to time the market or make quick decisions based on market patterns. Instead, he advises concentrating on a company's underlying value and investing in securities with a margin of safety. Next topic of this book is about investing in investment funds. The benefits and drawbacks of investing in investment funds such as mutual funds and exchange traded funds or ETFs are covered in the ninth chapter. Graham stresses the significance of looking at the costs and fees related to these funds as well as the track record of the fund management. The next and the last chapter of this book is about the investor and his advisors. The role of financial advisors and brokers in the investment process is covered in the book's concluding chapter or in the last chapter. Investors, according to Graham, should be careful of advisors who make exaggerated claims. So this is all about the book summary of the book The Intelligent Investor.